Did you know the RBI recently approved a record-breaking dividend payout transfer of 2.11 lakh crore to the central government for FY24? Not only is it higher than the budgeted amount, 1.02 lakh crore, but it is also more than double the amount paid last year, which raises an important question. Why does the RBI transfer its surplus to the central government, and how does the RBI earn money or profits in the first place? Let's tackle the second question first. As we know, the RBI plays a crucial role as the bank of banks and is responsible for minting money. In addition to this, it also generates revenue by overseeing financial markets, managing foreign exchange reserves, and trading government bonds on which it earns interest. And every year, it transfers a certain amount of surplus it has to the central government. Which brings us to the first question. Well, the RBI was initially formed as a private shareholders bank in 1935. However, in 1949, it was nationalized by the government, which became the sole owner. Therefore, under Section 47 of the RBI Act 1934, the RBI transfers the surplus to the government. However, before it transfers the surplus, the RBI sets aside reserve funds for contingencies. Given this year's surplus, the contingency risk buffer has also been hiked to 6.5%. And now that leads us to another question. Who will benefit from this surplus, and in what ways will it impact them? Up first, we have the government. This huge surplus makes it easier for the government to achieve fiscal consolidation and potentially reduce the fiscal deficit by 0.3%. This would lower the government borrowing and lower bond yields. Alternatively, the government may also boost infrastructure spending. In fact, there are reports that state that this 2.11 lakh crore surplus could help boost India's FY25 Capex outlay by 10%. And by the way, this can also lead to lower bond yield. How? Since government borrowing will be lower, supply of bonds will be lower, and consequently, with demand being stable, bond yields may come down further. Back to the beneficiaries of this surplus. Another entity benefiting from this will be banks. This surplus will also help improve the banking system liquidity, which currently has a deficit of 2.5 lakh crores. Surplus liquidity will lower short-term yields and consequently lower the cost of borrowings for banks. And the decline in the GSEC yield is likely to result in higher treasury for banks, particularly PSU banks. Last but not the least, we have the markets and the investors. You. This improved fiscal outlook aligns with the expected FPI inflows. This is mainly due to global bond index inclusion and the beginning of the rate cut cycle. You know how the equity market performs in cycles? The debt market also has its up and down cycles. Currently, we're in a down cycle where yields have already declined from 7.6 to 7.05, and the yields are only expected to decline further. Right now, the debt markets are attractively placed, and investors may want to participate in the current down cycle to enhance their fixed income return. Now, if you're looking to participate in this down cycle, you can try our one-click mutual fund basket of stable debt funds that's especially curated by our research team. And you can find this basket on the ICICI Direct app or the ICICI Direct website. Thank you so much for watching.
Please note, mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.